No one gives you a manual on how to raise a child. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, I'm going to be discussing how an investor typically scales their multifamily portfolio. And in very similar fashion, how we've done it, Jake and myself, and how a lot of our community members have done it. Where have they started? Where were their inflection points? And how are they able to scale and grow and become a really profitable real estate business? Now, before I start, I want to offer you our Wheelbarrow Profits book, a PDF download. If you want to email me, gino@jakeandgino.com, I'll send you a PDF copy. And down below, there's a subscribe button. Just smash that subscribe button. We put out content every week. There's so much content that we put out about multifamily, whether you're buying your first one, you're buying your next one, financing, interest rates, market cycles, whatever it is, we're posting it weekly. I want you to become part of the Jake and Gino community. Now let's dive in. We've created a technique or a strategy, something that we call the conveyor belt. And this is so important to understand how to scale your real estate business. If you understand this concept, things become more clearer and you'll be able to take action. Now think of an imaginary conveyor belt in front of you. It's there, it's a belt. Now let's put a timeline on this belt, because I think people mistake the idea of real estate. They think they're gonna buy an asset or a building, especially when they first start, and they're gonna hold it forever. That may be the case. It always depends upon what your goals, what your objectives are, how much capital you have. Do you want to leave your job? All these things fall into the mix. Now, for Jake and myself, we didn't know any better. We bought a ton of assets, over 2,200 units we've transacted on. Now, we've sold almost 500 of those. So we currently own almost 1,800 units without syndication. We've gotten rid of our investors. We don't need investors anymore. That's because we've used this conveyor belt. So the conveyor belt simply states you're trying to put assets onto this conveyor belt. Whether it's a single family home, you may have single family homes on, whether it's quads, whether it's a 20 unit, whatever it is, whatever asset you're focusing on. As it's on this belt, these assets start to age, start to matriculate, start to add value. Your goal is, you've bought it, how do you extract the maximum value? You're making money with cash flow, hopefully, but that's not where you make your big bucks. You make your big bucks in real estate when you exit the asset, whether that's a sale or a refinance. That's why many syndications have to be sold to extrapolate or crystallize that equity. Whereas when you're owning the asset, you can refinance it. And ironically enough, it's still on your conveyor belt after year 3 or 4 when you refinance. It doesn't come off, but the equity comes off, and you're putting that equity into another deal. So the goal is to stack as many assets on there. I had a conversation with one of our coaches, Vince, yesterday, and how he started his business. Before he joined Jake and Gino, he had around 40 units in Michigan, smaller duplexes, quads. He had a 12 unit. When he came to Jake and Gino, he was out of money. How do I scale this portfolio? I still told him the conveyor belt is important, but why not use the tool of syndication? And that's what he did. He used syndication, he raised capital, he started partnering up with others, and he started getting more deals on his conveyor belt. And as the years progressed, it's only been 6 years since he's been part of Jake and Gino, and he owns over 600 units. Some of those deals have come off the conveyor belt through a sale, and he's repurposed that money into his next deal that is bigger. A couple of his assets he's still holding right now. They're still working on the conveyor belt, and he's got a couple he'll never sell because he's got some really nice cash flow. But that's the idea of the conveyor belt. What you're trying to accomplish is trying to get as many assets on this belt, getting them to work, adding value, and then exiting them, whether it's a sale or a refinance, and getting that equity out that you created, and then you reinvest that equity into more assets. Now, how do people mostly start out in multifamily? This is really interesting. This hit me the other day. I'm sitting at home, and I've got to be honest, I miss having little kids. I love having toddlers around the house. So you may or may not know, I have 6 children. The oldest one is now 25. The youngest one is now 10. And as I look back through the journey of raising these children, when they're first born, it's as if you're buying your first multifamily. It is the Wild West. No one gives you a manual on how to raise a child. You're fearful. You're young. You may not have a lot of money. You're strapped for time. You're strapped for cash. When I look back at my first deal with Jake, very similar. Our very first deal, we didn't know what we were doing, even though I did take massive action. I had, massive mentorship going on. I was part of 2 mentorship groups. That truly helped me out. That's why I created Jake and Gino. I saw the value. Every time I had a question, I could pick up. It's really hard when you're a newborn parent. You're trying to get information from all other sides. How do they do it? Well, how do you decipher that information? And it's the same thing with multifamily. It was very challenging for that very first deal. But there were similarities between having a newborn and buying your very first deal. With the newborn, they need a lot of tender, loving care. You need to spend time with them. You need to make sure that they're fed every couple of hours, that they're changed every couple of hours. They cry a lot. It's constant, always on top of it. You're always thinking about them. There's a lot of work with them, but there's a lot of reward as well. They're so much fun. They're a joy to see. As you start seeing them getting a little bit bigger and opening their eyes, and they're moving and they're crawling, you get really excited. Well, think back to your first deal if you had one or you did one, or if you're about to. And I'll explain to you how our very first deal parallels having that child. The very first deal, we had a lot of deferred maintenance, a lot of CapEx, very difficult residents. It's what we call a value play. And I would even call it a material value play. It needed a lot of tender loving care like that first child, a lot of nurturing, but a lot of massive benefit, a lot of massive value came out of that first property. It was a C minus property, and probably a B minus to a C area, but we bought it at a good price point, and we were able to renovate it, fix it up, reposition it on the conveyor belt, and we were able to crystallize that equity. But that's where most investors start out with. They start out with those older properties that need a lot of tender loving care. There's a lot of value. There's a lot more cash flow, and there may be a lot more equity appreciation, but there's a heck of a lot more work involved, very similar to your first child. Now, as children start getting older, they tend to need a little bit less help, a little less, I don't want to say guidance, but hey, you're not around them every 2 hours making sure that they're breathing or that you have to feed them. They start doing things on their own. And as you start building up your portfolio multifamily, that's sort of what happened with Jake and myself. On our second deal, it was a little less hairier than the first one. It had just as much meat on the bone, but we started buying things a little bit differently. The asset was a little bit newer. Then the third deal, the asset was bigger, a little bit newer, and it was a function of the market cycle. Now, take a look at where my kids are now. Some of my kids have graduated, gone to college, and finished college. Well, when your kids are off to college, you don't really have as much connection with them, especially if they're staying away. Now, with me, it was different. Kids were coming home every day, but they don't need the hand-holding, the guidance, being on top of them every single day like they did with a newborn. And that's what ends up happening with the portfolio of people who are in this business long enough, and they start scaling. They start looking at assets based on one metric as well, called ROE, return on effort. They're willing to buy an asset that's newer, that has a little bit less value being able to add it on, but stresses out the system less. And that property holds value for a lot longer. And one great thing about buying assets that are newer, especially if you're a buy and hold investor, they stay new longer. So if you're buying a 2008 asset today, as we are, we're buying a 33 unit, we're closing it in a couple of weeks. Well, in 10 years, that asset's still going to be relatively new. And when you're buying these newer assets, it's like having kids off to college. There's not as much work involved. There may not be as much reward involved, but they're a lot more stable and they're a lot more scalable. And for the long term, these assets are great to hold on to. So for me, it's also the function of the market cycle. Where are we in the market cycle? Right now, everyone's focusing on newer assets. The problem with older assets in this part of the market cycle is that cap rates are still low. They're still expensive. They should be cheaper right now, but they're not. So that's why we're focusing more on the college age properties, if you want to put in that analogy. When those properties that are older get cheaper, then we'll go back into the cheaper ones, do more work, and then possibly, if you don't want to hold them long term, you can sell them, crystallize the equity, and move them up into these newer assets. But it is always is a function of the market cycle. And that's what I see a lot of our students doing. They're starting out with older assets, a lot more work. They're cutting their teeth. They're getting a better deal. They're looking at price versus value. And that's what we typically do when we start anything. We're looking at what does it cost versus what's the value. We don't take into consideration the return on effort because we only have 1 or 2 properties. That's what we're focusing on. But when you scale up and you have 14 or 15 deals, and then you have a couple of these older deals, you'll start saying to yourself, I know what Gino's talking about. These 2 deals are taking up 60% of my time, and these 12 deals are a lot easier to manage, a lot easier to get residents. There's a lot less deferred maintenance, a lot less stress on my maintenance team. We're always focusing on price and what we're going to get out of it versus the value. Let's take a step back. My recommendation would be if you're just starting out, look at the market cycle. Understand, I wish I could get into the 3 pillars of real estate, but go into a previous lesson that we've talked about the 3 pillars of real estate and where we are in the market cycle, and focus on what kind of assets do you want to tackle. When you're first starting out, your goal and your responsibility is to create as much equity in as short amount of time as possible to be able to crystallize that equity and move it into the next deal. And there's a lot of sweat equity involved. There's a lot of hustling involved. It's almost like raising a newborn. The goal is to get your kids in college, off to college, safe and secure, and it'll be an easier way to manage your properties. Now, if you have any questions, comments down below. If you think I'm nuts, let me know what you thought of this analogy. It just hit me the other day, and as I'm looking at my kids getting older, some of them need a little less attention than others, and it's very similar to our portfolio. We're buying much newer assets now. They need a lot less tender loving care. They don't cash flow as much. They don't have as much impact. They're not as fun as having toddlers, but there's less return on effort. Leave those comments down below. And I really just want to thank you for spending part of your day with me, taking those few minutes out and listening and learning and trying to get into multifamily. Either you're getting into it or you're scaling your next property. Thanks for spending the time with me. And as always, I'll see you on next week's How To. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.